Welcome, everyone. Thank you for joining us today. It is my great pleasure to introduce Pierce Crosby, the General Manager of TradingView Inc. To all of our live viewers, type any questions you have for Mr. Crosby in the chat box, and we'll try to leave some time at the end to get those answered. So let's go ahead and hand the floor over to you, Pierce. Thank you.
Awesome. Thanks, guys, and everybody that has joined us today. A pleasure to reconnect with some of you. I know I've already gotten some great messages from folks that I had the pleasure of seeing in Las Vegas. So glad we can continue the conversation after MoneyShow in Las Vegas, which was obviously a great show for the year. So as the team said, I'm Pierce. I run our U.S. operations and kind of global strategy for a company called TradingView. For those of you who are not familiar, TradingView is a technical analysis business, primarily specializing in advanced analytics across global markets, providing real-time data for more than 180 countries around the world. And obviously, we have grown a lot in recent years. So hopefully, if you haven't heard of us before, you'll bump into us sooner rather than later. So today, the team asked me to kind of speak a little bit about the current economic environment and what we have coming up this afternoon, which is the FOMC meeting. For those who don't follow nearly as closely and obviously can get up to speed, the FOMC is finishing a 2-day seminar where basically they talk about their expectations for the year. A lot of those expectations are built from financial data, looking at how the economy is performing and has been performing over the last year or even couple years relative to their key economic indicators. So what I thought would be helpful is to talk about, basically what is exactly expected to occur in this meeting, what people could position themselves for in the case that, we have a bearish case or a bullish case for markets, and a lot of those are going to be based on the outcome of that meeting come 2 p.m. today, and 2 p.m. Eastern is the time. So in order to actually best exhibit this, I do want to make sure that everybody understands kind of where we are today relative to where we intend to go, or where the economy looks like it's going in the near distant future. So this is TradingView, as you guys may have seen before. Usually we cover gold markets, so this might be my average dashboard and kind of how I look at markets on a relative basis. But we'll really simplify here and just want to talk through kind of how things are kind of shaping up in the U.S. economy. And really, if you think about it, we should position ourselves for a quick moment, if you put on your thinking caps, as say I am a federal chair or board governor in these situations. How would I really envision the economy doing overall, and thus am I positioned to make action or make movement in order to make sure that we don't have kind of an overheating economy or various areas of the economy that clearly are doing well or doing worse. So this is S&P 500. Everybody knows this chart, of course. We did hit all-time highs yesterday. We hit all-time highs today as well. So if I drop down the session here, we really can't seem to break through last Friday's high. But relatively speaking, we are on a very, very strong upward trajectory, and previously eclipsing the December 21 highs, which we know to be post-pandemic era. So in general, as you can see, I mean, even with higher interest rates, which we have all endured for some time, there really seems to be very little impact on the overall U.S. economy. And as a result, we do still see a really, really large outperformance in the S&P 500, especially relative to the rest of the world. And we can get into those various other asset classes in various geographies. So what's interesting with the S&P, sometimes the S&P oftentimes overstates its performance. And what I mean by that is that if the dollar, the US dollar, which we're looking at here, is doing relatively well or doing well relatively poor, this obviously has an outsized impact on the S&P 500. So in many cases, what ends up happening is a weaker dollar will allow for a lot of strength in the S&P 500. You have a lot of international inflows as a result because on a relative basis, the economy gets cheaper to purchase or cheaper to buy into. And that happens with a lot of emerging market economies where if you look at their index, their relative stock index, you will see a very, very strong growth trajectory. And you think, well, okay, maybe it's an amazing idea to invest in Argentina. But if you actually look at their underlying currency, the simple reality is Argentina's currency has fallen off a cliff. And we can obviously look that up. I believe it's you could actually look at the, let's see, specific instrument. Let's do Argentine peso versus dollar. I think, I don't even know if we have, here we go. So clearly the dollar is, this is based in dollars versus Argentinian peso. So you can see the debasement there and clearly the decline, if you will, of the, say, Argentinian peso as an example. Okay, so anyways, back to the US dollar. Clearly the dollar is in kind of a normal band since December of last year. We had actually a pretty significant pullback from the October highs where dollar was quite strong and dollar has obviously retraced somewhat, but now we're kind of moving in a relatively unimpactful range here. So from a Federal Reserve perspective, when we put that thinking cap back on, dollar doesn't seem to be moving dramatically one way or the other, even though we do know that money supply has obviously gone up quite a lot. Dollars in circulation are very, very high, but price seems relatively unimpacted. So that's quite interesting and clearly shows that dollar is still resilient, even though we have a higher interest rate environment. So how high are we talking? Well, important for, everybody usually already knows this, and this will be the main chart that we'll kind of be focusing on today. The actual federal funds rate, the rate at which I could actually, you can use a bunch of different chart types here, but to make this maybe look a little more clear for viewers and more kind of distinct, if you will, we can make it a little more granularized. So federal funds rate, obviously following kind of the change in regime or change in philosophy from the Federal Reserve, we see a dramatic shift from what previously was essentially zero interest rate policy, during the 2020 to 2022 era. Obviously, there was a initial uptick, and then obviously with kind of COVID, et cetera, massive kind of downtick in interest rates. So here we are from a relative federal funds rate, where if you want to borrow, ultimately you are borrowing at a 5.3%, and that is for the longest time kind of or almost, I'd say, go on half a year now, the effective rate, which then trickles out into the rest of the economy. Most notably for people where this trickles down is clearly the actual mortgage rates. Mortgage rates are kind of the most important factor, which people are ultimately going to feel if you have a higher interest rate environment. So the biggest difference between these two, of course, is you really have basically a fixed borrowing rate. Then you have what banks charge on top of that, and you see kind of the spread there of about 1.5%, which is the rate that banks charge on top of, say, the federal funds rate. So these are perfectly kind of in line, if you will. There's some spikes here, obviously, because there's a lot of anticipation about if rates were to go up or not. But clearly, we do see a very, very similar correlation of the two. So getting back to this main chart, the discussion at hand is exactly as I marked out these little X's ahead of time. Does the Federal Reserve think this year is the year to actually start bringing rates back down? Now, historically speaking, if we do look at kind of rate environments, basically the Federal Reserve does jack up rates quite quickly. and then they hit very similar rates, and they maintain those for upwards of, on average, something like 6 months, but sometimes up to a year. Now, following these interest rate environments, basically, the goal is to push the economy into something of a recession, where essentially the economy kind of seizes up relative to what it previously was operating in, because the cost of borrowing money is much more expensive, and that filters down into very, very simple things like the ability for me to open a small business. Maybe I'll actually hold off on doing that, knowing full well that it's actually very costly for me to do that on a relative basis. So as you can see, we have similar types of interest rate spikes, and obviously going back to the 80s and 90s during the savings and loan crisis. I mean, on a relative basis, it is very, very interesting that people are bemoaning 5.3%, because on the high end, clearly at the turn of the century, or in the 80s and 90s, we had something close to 20% interest rates from the Fed. And again, a mortgage would be even higher, right? So maybe even 25% on a mortgage, which seems astronomical at this point in time. So what is anticipated and what's being discussed is whether or not this year the Federal Reserve is interested in reducing rates or starting to drop rates back down. So the thinking is we basically have 3 meetings throughout the year, which are scheduled to potentially consider dropping rates. However, as you can see historically, once rates start dropping, they consistently do continue to drop. So in this case, if we're thinking about it, there are 3 scheduled meetings this year, which are considered to be rate meetings. And after that, it would be very, very interesting to see where things go. But we can kind of project that they will kind of move in a similar direction or similar manner, basically moving rates very aggressively back down. We see very few instances, maybe in the 89 to 92 era, a less kind of dramatic fall, if you will. But on average, they move quite quickly once they decide that interest rates do tend to decline. So the goal being, of course, is you don't want to tip economies completely into recession. You want to kind of thread the needle, if you will, which is what a lot of the board governors have been telegraphing, is that they're hoping to thread the needle. But this is the anticipated plan for kind of 2024. Start to reduce rates at a 25 basis point rate per meeting, thus getting us to this kind of December meeting and back down to something similar to, say, a 4.5 to 4.25% interest rate. So why is this really important? Well, in a lot of cases, if the drop in rates starts to occur, basically a lot of firms are due to benefit from that, and others are due to have very strong headwinds. So who's due to really benefit? In simple terms, the most common folks that are due to benefit are firms that actually deal with a lot of short-term borrowing and short-term lending. And so here you see, say, Meta as an example. Meta for a long time has obviously done historically well, or very, very, very economically well. But they continue to outperform even the S&P 500 in terms of the overall kind of strength of their business. So this is just looking at since kind of the November 2022 lows, so just a year and a half, we see a huge kind of surge of Meta. For those who are unfamiliar, we actually now have full financials on TradingView. So if you wanted to see, Meta's revenue, even revenue per employee or something like this, we can definitely, give you a more kind of granular understanding of, say, total sales or total revenue or something like this. So I always look at, does this trend generally follow the overall trend? In this case, you can see that, Meta's revenue clearly is improving, but not at the same rate, of course, that their actual stock price is improving. A lot of that is baked into the fact that people believe interest rates will begin to fall. So if it is kind of telegraphed or broadly believed that you could expect that federal funds would indeed go down, it makes it easier for tech companies to borrow cash. And thus, there's a big, big upside for them to borrow tons of cash to build faster. And if you can build faster, well, clearly you can gain more market share. more revenue will come of that business, and ultimately there is kind of a cascading order of effects. So technology in general is considered to do extremely well if we do move towards this trajectory. However, others, notably financials, and I'll start with the XLF because XLF is a clear indicator for general kind of financial performance. XLF is, I think, at all-time highs as well. In fact, yes, very much at all-time highs or reaching all-time highs. However, there's a bit of a different story happening under the hood of XLF because XLF actually added a lot of payment processors to the portfolio of the ETF itself. Historically speaking, XLF was a financials-only ETF, and now they're starting to incorporate what were previously considered tech companies into this index. And so in which case, XLF is now becoming kind of more fintech than it was traditionally, say, banking and finance. So one thing to consider is, you now have companies like MasterCard, Visa, PayPal included in this ETF, which is very different than pure banking and finance. But under the hood, if you will, of XLF, there are some key names to watch out for. If you're looking at, how banks will perform or how banks are intended to perform, and let me change these to full candles. JP Morgan is clearly the most important company in that index from a financial standpoint. And as you can see, JP Morgan is indeed reaching all-time highs as well. This is truly a categoric, massive win for this business, and Jamie Dimon, the long-standing and probably oldest major bank CEO across the entire space. Now, the ability for them to continue to put up these insane numbers is a little bit tied specifically to this previous chart. So why do banks benefit from higher interest rate environments? In simple terms, what they can charge you. So if you were to actually go get that mortgage, say we'll go back to the 30-year mortgage, what they can charge you is much higher than when we're in a zero interest rate environment. Their ability to charge you interest on top, it becomes increasingly smaller and smaller. And so in a high interest rate environment, JP Morgan also sits on billions of dollars in cash, and a lot of those cash and cash equivalents are rolled into things like treasuries, 30-year treasuries or 30-year federal funds, which ultimately do net them a massive windfall on the actual cash receivable side of things. So as a result, JP Morgan actually just came out with an update that they are adding a significant portion onto their. You can always check the top news here on the lower left side rail, or lower right side rail rather. But in terms of most recently, they've actually hiked their dividend. This was yesterday, and the dividend now is almost a 10% increase prior. So this is extremely well received by markets, that they are not just continuing to pay their dollar dividend, but they're actually increasing that from a payout perspective, which is really shocking, I think, across the sector. So why now? I think in general, they are hiking as the Fed is considering to cut, if you will. Now, a lot of people believe that this is a way to make sure that people understand JP Morgan is a healthy business, et cetera, irrespective of kind of the larger trend, which will be that interest rates will begin to cut. And ultimately from that, you'll have kind of shakier expectations from an earnings perspective when it comes to a lot of these financials. So in simple terms, really good to keep track of, say, long-term businesses that are focused on building really amazing technology, and keep track of financials businesses, which may not have nearly as much free cash flow as they have for the last year to go around, knowing full well that interest rates will decline. So some smaller names of interest, and these are also wrapped up in that ETF we were talking about, but a good example is PNC Financial. Now, PNC Financial is a mid-tier bank. They're not a massive bank, but they are clearly a large bank, at least. You can see when it comes to actually mid-tier banks and kind of mid-market banks, there isn't a ton of outperformance. In fact, we're looking at a trend from 2010 up to 2024 there isn't a substantial run up, if you will, versus say a JP Morgan, which you have this much more massive kind of outperformance relative to the market. So if you really dig into say mom and pop banking, if you will, mostly people that are doing simple commodities loans, small business loans, et cetera, there's a very different picture. It's not nearly as rosy, if you will, from the big banks. So these are clear areas to watch out for, because they clearly will benefit from a lower interest, or they clearly will not benefit from a lower interest rate environment. And meanwhile, we have companies like, say, Intercontinental Exchange. So Intercontinental Exchange is also included in the XLF, but for those who don't know, it is the owner of the New York Stock Exchange, as well as other exchanges around the world. Clearly, irrespective of, say, interest rates, the trend around trading and investing continues to, kind of accelerate throughout the industry. And so we have things like Robinhood, things like low-cost investing, and different ways for people to get started investing. Clearly, this has benefited a lot of these data companies and exchanges, Intercontinental being the single largest. So in a higher interest rate environment, we do tend to see less investing overall, but this really hasn't impacted Intercontinental Exchange. Now, if I'm the Fed, I'm clearly looking at this, because if trading flows or trading volumes begin to decline, that's a clear indication that we are moving towards maybe a recession type environment. Whereas here, clearly there is no type of recession, at least priced in from there. So these are the sectors I would definitely watch out for as we come up on the 2 p.m. meeting today and the 2:30 minutes. Now, turning to the other side, those who may benefit. In the case that we do actually have a drop in interest rates, one of the clear areas that a lot of people are talking about, and this is very, very important relative to mom and pop investors, especially because Bitcoin has become an ETF, meaning it's very much accessible for everybody's 401ks, for average investors to actually invest more meaningfully. Why does this matter? Well, in a lower interest rate environment, people are clearly, too short of a time frame. People are clearly interested in the idea of investing in more risky assets. And so investing in more risky assets, for all intents and purposes, means going way out the curve in the NASDAQ 100, which we can look at. But another clear area of interest has been crypto in general, and specifically Bitcoin, due to the fact that it is now kind of accessible for the everyday investor. Since the launch of the ETF, we actually do already have a massive price increase. So I think the ETF launched, I want to say, probably around maybe November of this year, or November of last year, maybe even a little bit after that. But we've already seen a massive upsurge from a price of something like 40K to 60K, or even 72, back down to 60. But this is clearly an area that you should be watching. Notably, on the downside, if the Federal Reserve decides, and let's go back to the initial chart, if the Federal Reserve decides to not actually proceed with rate increases anytime, or rate decreases rather, anytime soon, and maybe they actually do push these meetings out, meaning is it two rate decreases this year, or three? If we do push it out to actually being probably 2 versus 3, a lot of these tech companies, et cetera, as well as kind of alternative assets like Bitcoin, may not see nearly the amount of inflows that we kind of predicted, due to the fact that higher interest rate environments make it much harder for companies to borrow, and people are very happy with their basically their 2% or their 5% from a kind of yield perspective. So in this case, it's definitely something to watch. And if we do see that there's little anticipation around 3 rate cuts, then you can definitely see probably a fallout from that, where price and interest around these kind of high flying tech names or alternative assets may come down a lot. And so I think I'll pause there. This is just a bit of a primer to get you guys kind of ready for the day. In general, from a trading perspective, it's always hard to trade these economic events, but just keep in mind how your portfolio is positioned overall. Especially due to the fact that, there are some brands that are extremely exposed when it comes to things like, interest rates coming down or not. Zillow is a really good example, where obviously if rates do not come down, we do obviously have a higher price or higher cost, if you will, to purchasing properties. Obviously, you have much less interest then in people looking at properties. And so companies like Zillow are perfectly exposed for that. And then finally, we didn't get into this too much, but you also have companies like Lennar or NVR, various other firms that are really, really well-known home builders and have been doing absolutely incredible numbers. I think a lot of this is baked into the fact that they anticipate that there will be rates coming down, but in the sense that if rates are not coming down or actually going to be paused at a higher interest rate environment, even buying new homes is going to be a more challenging endeavor, rather than just purchasing existing homes, but a more challenging endeavor for kind of new families or new kind of new kind of purchasers, if you will, overall. So yeah, with that, also important to keep in mind, one thing the Fed will be watching and going into the decision, I do always kind of keep in mind how our overall housing market is doing on a relative basis. You can see that we continue to march higher, and these are kind of the seasonalities that you can see every year, of course, so nothing unusual here. But over the last, since 2020 really is kind of when there's a reset on a lot of this stuff. We do actually see that there is kind of a substantial increase. In fact, almost a 30% increase above 2022 or 2020 on U.S. home pricing. Now, this was expected to fall off more substantially with higher interest rates. However, it remains extremely resilient, which may indeed feed into the Federal Reserve not wanting to cut rates sooner rather than later. So this is definitely something to keep in mind as an input to, again, if we're thinking about, I'm the Fed, what is my anticipation of actually cutting, knowing full well that we do actually have a substantial price for single family homes, and these remain kind of on a relative basis, extremely highly priced relative to where they were even a decade ago in 2012. So more than 100% in terms of price increase overall. So I'll pause here, and I think if we do have any questions, I'm happy to dive into those. I don't know if anybody in the chat had anything to add, but
yes,
obviously,
of course. There are questions, Mr. Crosby. Over the long term, how much overinflation has the 10-year TSY traded at?
How much overinflation has a 10-year TSY? I mean, in terms of looking at inflation in general, I actually had a good chart for this. Let's see if we could pull up 10-year inflation. Where do we have? Well, let's look. I actually had this up earlier. I didn't want to add it because inflation is a whole new topic, and so we have year over year, we have 5-year break even, and the 10-year break even. So let's look at the 10-year just because it's obviously very interesting to see what this looks like. So on a relative basis, on a 10-year average, we're still slightly above where kind of a median range is. But as you can see, inflation has obviously had these massive spikes down in 2020 as well as in 2009. But inflation does not seem to be coming down whatsoever. This is clearly an indication to me that the Fed has not kind of hit their target or their mandate for 2% inflation. However, we do kind of see a general trend slightly downwards, at least from the peak, if you will, in April 2022. But safe to say, no, that we really haven't gotten there yet. And this indeed may be a key input for why they may hold off this time around in terms of reducing rates. And as I in general have said a little bit, I do think that because specifically inflation as well as home prices, they may indeed want to move this out a little bit. So, meaning there may not be a rate kind of decrease in this month, but actually looking forward to say the July meeting or the November meeting comparatively.
Okay, thank you so much. And I want to thank everyone for joining us today. We are at the end of our time. Thank you so much, Mr. Crosby, for your presentation. And I hope everyone enjoys the rest of their day.
Thanks, guys. Much appreciated. And yeah, find me on Twitter as well as on TradingView. Feel free to reach out with any questions you might have.
Oh, well, thank you, Pierce. That was awesome.
Cool.
I hope
no, thanks for having me. That was
Of
great.
course,
And
yeah.
it was a good meeting, good sesh. Just prime people for today. And yeah, keep me posted if there's more comments or questions. And are you guys going to post this to MoneyShow as well?
Yeah,
Or
it'll probably take about a week to go through post-production, but yes,
okay.
it will be up on the website.
All right. All good. Yeah, cool. Hopefully it was helpful. Any context on attendees in terms of like numbers or things like that? I'm curious.
So I can't see all the numbers right now, but we can send that to you. Let me make a note to send you that email because there is a way we can look at it and I will let you know.
Cool. Yeah,
okay,
great.
Awesome. Thank you so much. Enjoy the rest of your day.
Happy Wednesday. Talk soon.
You too.